Here is something nobody in the financial media wants to say out loud. Two investors, same amount of capital, same market, same 10-year window. One of them watches their portfolio cut in half twice in a single decade. The other one? They don't just survive those crashes, they actually accelerate through them. Their net worth grows faster during market chaos than it did in the calm. Now, most people watching that story will say that second investor just had better stock picks, or better timing, or some inside knowledge. But that is exactly the wrong conclusion. And that wrong conclusion is costing people, right now, hundreds of thousands of dollars in wealth they should already own. The difference between those two investors was never the assets they held. It was the structure underneath those assets. And today, that is what we are going to build together. Welcome back to WealthForge. I'm Dr. Ben, and if you are new here, I want to be completely clear about what this channel is and what it is not. This is not a show about tips. It's not about following trends or chasing whatever asset class is exciting this week. We do not do that here. At WealthForge, we operate from a very specific philosophy. We don't follow the market. We design the moat. In a world full of followers, people waiting for the next guru to tell them what to buy, which sector is hot, which coin is about to pop, we are the architects. We build structures that generate freedom, not just returns, freedom. That distinction matters more in 2026 than it has at any point in the last 20 years. And by the end of this video, you're going to understand exactly why. Today, we are going back to foundations. We're calling this Structural Assets 101. And I want to be honest with you. If you skip this one, the more advanced blueprints we'll be building later in this series will not make full sense. This is the vocabulary. This is the grammar of the entire architect's framework. So let's go. The myth of passive portfolio growth. I want to start with a myth. One that was sold to an entire generation of investors so effectively that most people have never once stopped to question it. The myth goes like this. Just buy a diversified portfolio of index funds, hold them for 30 years, and the market will do the work for you. Now, is that advice completely wrong? No, not entirely. But here's what that advice leaves out, and what it leaves out is catastrophic. That advice was constructed in a different economic era. It was built for a world where inflation stayed low, interest rates were predictable, institutions were stable, and a 60-40 portfolio of stocks and bonds was genuinely a fortress. That world is gone. In 2022 alone, the classic 60-40 portfolio, the one that financial advisors have been recommending for 40 years, had its worst single year since 1937. Not since 2008, not since the dot-com collapse, since 1937. And yet, the mainstream financial conversation barely changed. The advice, still the same. Hold, be patient, it'll come back. But here's the real question, the one that nobody asks you. Come back to what? Because if your purchasing power is eroded, if inflation has taken 30% of your real wealth, if the systems you needed that money to fund, your retirement, your children's education, your business, if those timelines moved forward while you were being patient, then it came back on paper is not actually a victory, it's a delay of the same problem. This is the central failure of passive portfolio thinking in 2026. It treats your financial life like a garden, something you plant, water occasionally, and expect to grow on its own. But you're not a gardener, you're an engineer. And engineers do not leave critical systems on autopilot and hope for the best. The great fortunes, not just the famous ones, but the quiet, generational ones, were never built on passive hope. They were built on deliberate structure. And that structure has a name. We call it the architect's lexicon. Structural assets versus liquid plays. Before we get into the specifics of the lexicon, I need to draw a line, a very clean, very important line. On one side of that line, liquid plays. On the other, structural assets.
Most people, and I mean most people, including a lot of sophisticated investors, have their entire financial life on the wrong side of that line, and they don't know it. So let me define these clearly. A liquid play is any position where your wealth is stored in something you don't control, that can be taken from you by market sentiment overnight, and has no productive function beyond its perceived price. Stocks in companies you have no voice in, crypto held on an exchange, a savings account eating itself alive with inflation. Even most mutual funds fall into this category. These are not bad things to have. I'm not saying burn your brokerage account, but here's what I am saying. None of those things are load-bearing. Think about a building, any building. There are decorative elements, the tile in the lobby, the art on the walls, the lighting fixtures. They add value, they look good, people notice them. And then there are load-bearing walls, the columns, the foundation, the structural steel. You don't remove a load-bearing wall to make the lobby look bigger, because without it, nothing else stands. A structural asset is your load-bearing wall. It's a position where your capital is not just sitting somewhere waiting to be repriced. It is doing something. It is producing output regardless of what the S&P 500 did today. And critically, it's something you own in a way that cannot be diluted or repriced away from you overnight. Let me give you 3 concrete examples so this is not abstract. Example 1. You own a small warehouse property that's leased to a logistics company on a 10-year triple net lease. The market crashes, tech stocks drop 40%, but that lease, that rent check, still arrives on the 1st of every month. The underlying business function, storage and distribution, still exists. You own that function. That is structural. Example 2. You hold intellectual property, a patent, a licensed process, a proprietary methodology that other businesses must pay to use. That royalty stream doesn't care about interest rates. It doesn't care about the Fed's next move. It generates value because the underlying utility it provides is real and ongoing. That is structural. Example 3. You own equity in a business that you partially operate or advise, one with real recurring revenue, not a stock, not a fund, ownership with a function, with a moat, with a reason to exist that is independent of market sentiment. Now contrast all 3 of those with someone who has $300,000 in a diversified index fund. On paper, that looks responsible. It looks smart. But ask yourself, what does that capital produce when the market is closed? 0. It just sits, waiting for someone else's sentiment to determine its value. That's the difference. Structural assets produce, liquid plays wait. And the architect's framework is built on accumulating the first kind, systematically, deliberately, in a sequence that compounds over time.
All right, now we build the vocabulary. I want to walk you through what I call the 3 pillars of the foundational blueprint. These are the 3 categories of structural assets that form the base layer of any resilient, freedom-generating financial system. Master these 3 concepts today, and you will immediately start seeing your existing holdings in a completely different light. Pillar 1. Private infrastructure. Private infrastructure means owning the systems that other people or businesses depend on to function. This is not limited to physical infrastructure, pipelines and power plants, though those qualify. It extends to any privately held system with a captive user base. Think private lending. You become the bank. Other people borrow capital from you at a rate you set, secured against collateral you approve. The interest comes to you. The schedule is contractual. The market's daily swings are completely irrelevant. Think proprietary distribution networks. Owning the channel, whether that is a media platform, a distributor relationship, or a franchise model through which products or services flow. The channel has inherent value because it is a dependency. People need access to it. That access is yours to negotiate. The question every architect asks when evaluating an opportunity is not, what is the yield? It is, does this give me ownership of a function that others depend on? If the answer is yes, That is infrastructure. That is worth investigating. Pillar 2, intellectual property and automated equity. This one is increasingly the most accessible to everyday people in 2026 and the most underutilized. Intellectual property is any proprietary knowledge, system, brand, or creative work that generates economic value beyond the hours required to create it. A course, a SaaS product, a licensed framework, a brand that commands a premium. The key word there is automated, because the goal of IP is not to trade your time for money once, it is to build something once and have it generate value repeatedly with minimal ongoing input. This is what I call automated equity. Equity that grows its own value without requiring you to be present for every transaction. And here is the part that most people miss. IP does not need to be protected by a formal patent to be structural. A process so refined and so well documented that no competitor can easily replicate your results, that is intellectual property. A brand with such loyal community that customers self-select toward you, that is IP. It's a moat with no gates because no one else can build the exact same moat. Pillar 3, utility moats. A utility moat is perhaps the most elegant concept in the entire architect's lexicon. A utility moat is a structural position that remains essential regardless of what happens in broader economic conditions. It is not cyclical. It is not correlated to sentiment. It exists because the underlying human need it serves does not go away. Healthcare infrastructure, food production and storage, water rights in water-scarce regions, energy independence, data storage and processing. But also, and this is important, human skill moats. The professional whose expertise is so rare and so critical that demand for their services does not fluctuate with market cycles. The consultant whose methodology cannot be easily outsourced. The operator whose specific knowledge makes them irreplaceable in their industry. A utility moat answers one question. If this economy contracted by 40% tomorrow, would people still need this? If the answer is yes, you have found a moat worth building. Now here is where it gets interesting, and this is the part I really want you to sit with before we move forward. These 3 pillars do not operate in isolation. The real compounding happens when they interact. When your private infrastructure generates cash flow, that cash flow funds your IP development. Your IP builds brand authority and a community. That community creates a utility moat because now you have an audience that depends on you for orientation, for guidance, for the systems they use to navigate their financial world. Each pillar feeds the others. That's what makes it a system and not just a list of assets. That interconnection, that self-sustaining ecosystem is exactly what separates a portfolio from a fortress. Engineering stability in an uncertain economy. Let me bring this into 2026 specifically, because the framework I'm describing is not theoretical. The market conditions of right now are demanding it. Here's what we know about the current economic environment. Interest rates have been on a prolonged normalization cycle that has fundamentally changed the cost of capital. The era of cheap money, where you could borrow at 2% to buy anything and inflation would do the work of making it look like genius, that era is over. What that means structurally is this: speculative positions are getting punished. Assets that could only justify their valuations in a zero-rate environment are repricing. The digital hype cycle, the SPACs, the meme stocks, the NFT market has experienced a multi-year contraction that is still not fully resolved. But here's what's simultaneously true and what almost nobody is saying loud enough. Tangible, functional assets, the structural ones, have performed. Private real estate with strong lease structures, infrastructure investments, royalty-based income streams, businesses with pricing power and recurring revenue. The divergence between structural and speculative is not just a theory. The data from 2022 through 2025 has validated it at scale. And this creates one of the most important windows we've seen in a generation, the opportunity to convert volatile gains into fixed structural positions while valuations on structural assets are still being overlooked by the market majority. Here's how an architect thinks about that conversion. Say you'd made significant gains in a liquid position. It's had a strong run. Most investors sit on it, watching the number go up, telling themselves they don't know when to sell. That's a gambler's mindset, not a designer's mindset. An architect asks, what structural position can I acquire with these gains that will generate cash flow and compound independently of this market's next move? You take the speculative win and you lock it into structure. You convert market fortune into system ownership. That discipline, that deliberate conversion cycle is what separates the people who had wealth from the people who build it. And the shift that this requires is a fundamental shift in identity. You stop being a market participant, someone who shows up every day to see what the market will do to them. You become a system designer, someone who controls their own economic environment. That's the shift. That's the whole game. Your first blueprint, moving beyond the basics. All right, we've covered a lot of ground today, and I want to make sure you leave this video with something you can actually use, not just a set of concepts that sound good and disappear the moment you close the app. So here's your first blueprint. 5 steps. Concrete. Start this today.
Step 1. Audit for load-bearing positions. Go through your current holdings, every account, every investment, every asset. For each one, ask a single question. If this disappeared tomorrow, what function would I lose? Or would I just lose a number on a screen? Anything where the answer is just a number, that is a liquid play. Not necessarily bad, but not structural. Mark it. Know what it is. Step 2. Identify your existing moats. You almost certainly have at least one structural asset that you are not currently treating as one. A skill set that is rare in your industry, a professional relationship that gives you access no one else has, specialized knowledge that others would pay for. Write those down. They're the seeds of your IP layer. Step 3. Find one structural position you can enter in the next 90 days. It does not need to be large. It does not need to be complex. A single small private note, a first piece of income-producing real property, a licensing agreement for something you have already built. The first structural acquisition trains the muscle. It changes how you see every future opportunity. Step 4. Calculate your conversion ratio. What percentage of your net wealth is currently structural versus liquid? Most people, when they honestly calculate this, find they are 90% liquid, sometimes more. Your goal, over time, through deliberate conversion, is to get that number to a place where your structural base generates enough cash flow to fund your lifestyle without touching the liquid layer. That is the threshold. That is what financial freedom actually means in an architect's framework. Step 5. Commit to the vocabulary. This sounds small. It is not. The way you speak about your finances determines the way you think about them. The way you think determines the decisions you make, and the decisions you make compound into your reality. Start using the words structural asset, utility moat, automated equity, foundational blueprint, conversion cycle. When the words become fluent, the concepts become instinct, and when the concepts become instinct, the decisions become automatic. That is the beginning of the architect's mindset. I want to close with something personal. The reason WealthForge exists, the reason I sit down to build these frameworks for you, is because I spent years watching people who were genuinely intelligent, genuinely hardworking, genuinely trying, watch their financial futures slip sideways. Not because they made bad decisions, because they were playing a game with rules that nobody gave them. They were told to diversify, hold, wait,
And they did everything right within that framework, and the framework itself was the problem. What you now have, this vocabulary, these three pillars, this distinction between structural and liquid, this is the beginning of a different framework. Not just a different investment strategy, a different relationship with money, with ownership, with your own economic future. The architect does not sit in the stands and watch markets move. The architect designs the field. And that process, that shift from watcher to builder, starts with exactly what you did today. You showed up. You asked the better question. You chose to go deeper than the surface level answer. That is what architects do. Now, here's what I need from you. If this framework landed, if something in this video changed the way you see your holdings, your income streams, or your next financial decision, drop the word architect in the comments. One word, that's all. I read every single one, and it helps me know who's in this with me so I can build the next blueprint for the right people. If you want to go deeper immediately, the next video in this series is already built and waiting for you. We're going into utility modes specifically, what they look like in the real world in 2026, how to identify one that's accessible at your current capital level, and the exact sequence for acquiring your first one. That's the next level. Click through or it's linked in the description. And if this is your first time on WealthForge, subscribe and hit the notification bell. We don't flood your feed. When we post, it counts. Every video in this series is a blueprint, not a broadcast. We don't follow the market. We design the moat. I'll see you in the next one.